Hey guys, welcome back to another episode of Shifting Gears. My name's Grayson Harris. We got Henry Byers over here. We're going to take a look at what's been going on in the freight market lately. A few predictions that we've made have either worked or haven't worked. We're starting to sort of see how things are going a little bit. Not necessarily a huge week in freight, but there are some signs that are pointing to some pretty interesting stuff, coming up in the holidays, especially with really just all the stuff coming out of Southern California. I think that'll be what we focus on the most is LA and Southern California. So without further ado, Henry, go ahead and take it on over, man. What you been looking at lately?
Well, I think right out of the gates, there's, a couple things to consider as we move deeper into the second half. Obviously peak holiday retail season, but then some external factors that could disrupt, freight entirely. Hurricanes haven't really done it this year. There really haven't been hurricanes that have, stayed over a certain amount or certain, part of the country long enough to really do, insane damage. There's certainly been some decent hurricanes that have done damage.
It was predicted to be the worst hurricane season, if not ever close to it.
Mm-hmm.
And oddly enough, it really hasn't been like hasn't been a named storm other than Hurricane Francine that just came in 3 weeks, 4 weeks. It's been a minute.
It has. So if you think about, there's still time for a couple hurricanes potentially. But at the same time, I think what we're showing here is that even if, a hurricane, if one or two more hurricanes hit, unless it does Harvey-like damage, which if we go back to Harvey, the reason it was so disruptive, it stayed over a certain period of land for about 3 days. It had 3 separate landfalls. It really was almost as disruptive as even, Katrina was in some regard. But Katrina, why the reason that was so devastating was the levees that broke. And so maybe we're seeing that hurricanes may not be as disruptive unless, they do that same type of damage that Harvey did. But regardless,
right.
I just wanted to point out the volatility, that just the external risk, the port strikes is the next on the list. Obviously, probably the most important at this point.
Absolutely.
But definitely needed to mention we're still not done with hurricane season. The East Coast port strikes, Gulf Coast port strikes, it seems to be escalating, at least from the rhetoric that you're seeing from the port workers there along those ports, but shippers seem to not be diverting volumes en masse. It seems that many shippers may still have some hope that it gets resolved before those volumes land. So what that says is these port strikes could be massively disruptive because there hasn't been a huge diversion, and then even more so, the escalation in terms of volatility and volumes that it could put out on the West Coast. So we're seeing diverted volumes. Don't get me wrong. We're just seeing strong peak volumes to the East Coast and Gulf Coast regardless.
Yeah.
East Coast rates, container rates, even took another leg up here recently. And as we talked about, if you hadn't shipped your stuff from China and East Asia to the East Coast, this is what those Trans-Pacific rates are measuring,
right?
Then you're not making it, and then some. So perhaps people think if it did shut down, it may be a week, maybe 2 weeks. Maybe we can afford that. But at the same time, they say, for every day it's closed, it may be 5 days for it to recover. So right out of the gates, strong peak season on the West Coast, port strikes, hurricane season not over yet. It's just potential things to watch, obviously. But then that kind of brings us back to, okay, where are we at current state? And it's been very difficult to predict, what is going to happen because the underlying capacity question is just how much capacity is truly on the roads. Usually we have to get kind of a proxy for that. You see how many carrier exits there are, which have actually increased over the last few weeks. Right. The rate of exits versus entrants. That new capacity coming online, you just can't overlook that, right? You can't overlook the fact that there are carriers coming on that perhaps are maybe it's coming on for specific reasons to fill certain niches that shippers may have. You see what I'm saying? Like it's not the same type of capacity that may come online at the peak of a peak, right? It's usually a more conscious decision, a more conservative decision to come into a bad trucking market, usually to try to catch maybe that next upcycle.
Right.
Contract rates tend to react to spot rates. Spot rates went up and really showed some bullishness prior to July 4th.
Right.
Then the holiday hits, contract rates start to ease back up. spot rates start to fall back off. So you have market's still oversupplied. Don't get me wrong. It's a soft market. But I think those factors may have led to a bit more of a depression, a decline in outbound tender rejections that we may have seen otherwise if there wasn't so much uncertainty surrounding this year with the election and whatnot. So let's maybe add that to the list of potential volatility.
Sure.
But neither here nor there. Fuel's down, and so when you look at spot rates, dry van spot rates, not looking great when you look at this chart. Not looking great. Labor Day disappointed to the downside in a very, very big way.
Yeah.
And I think just the downwards pressure that fuel's helping when you include fuel in all-in rates. But even on a line haul basis, if you looked at this on a line haul basis, rates have stabilized slightly from really where they were in June, kind of late June, early July. We're going to need to see some action from the rejection standpoint in order for the spot market to show a strong recovery.
Yeah, I mean, what do you think could be sort of leading to that stall? Because, leading up, so basically from July until September, it was just sort of a dud. We would have maybe expected it not to be so much of a disappointment. But not only has it gone down, it's gone below last year, and last year was not a good market either.
Well, it all boils down really to demand, right? Even if there is a surplus of capacity, if demand were to strengthen in a big way, it would put upwards pressure on spot rates, regardless. So when you're looking at how much volume's out there relative to the carriers and trucks on the road, we saw coming out of July 4th really pretty flat, but there was a pretty steady downward trend there until really early August, and then we started to increase just slightly. That all changed coming out of Labor Day.
Yeah.
So we're seeing some signals now that we thought we would have seen a little bit earlier. But again, we talked to it last time, this wait and see approach. When ocean rates increase 3 times, 4 times, your team's sitting there at the table. They're saying, okay, truckload team, we cannot let this escalate to the truckload market. What can we do? We talked about contract rates increasing. You start to hedge your bets against that volatility. Right. July 4th signals, hey, there's potentially monstrous volatility that could arise. Shippers start to kind of hedge against that risk.
Right.
So demand stays flat, actually declines a little bit. I mean, these are kind of perfect conditions for the spot market to stay soft, right? These volumes are strong on a contractual basis. Carriers who have accepted slightly higher rates are accepting that freight. And for shippers, it's increased their buying power. It's helped them out. Yeah. They essentially have the pricing power, you could say, in this market. But again, this demand coming so strong out of Labor Day is just something to really make sure you're taking note of because of where it's happening. It's happening in the Los Angeles and Ontario markets, the Inland Empire in Southern California, just as we have been talking about. So if you talk about things that we got certainly correct, record-breaking volumes coming into Los Angeles, the potential exposure that the truckload market had, we could be seeing that materialize now. But when you see the chart here in a second on rail volumes, it's pretty mind-blowing that the rail's been able to handle so much volume. Yeah,
really. I mean, that's probably the one thing that has been the biggest opposition, I would say, to our theories so far is, when is this going to happen? It would probably happen earlier than it did happen. Well, why did it take so long? I mean, those rails are handling it.
Yeah. I mean, you could really say it's why it's hard to even compare years past. I mean, you always want to try to compare past years to understand, are we growing or are we shrinking? But essentially, at the end of the day, you mentioned it a couple times. We've been down for so long that companies have had a chance. Not only have the bad companies, exited or are doing poorly and may exit soon. The ones who are there are perhaps stronger operationally than ever before, leaner. It's not the same. That doesn't apply to everyone, but I would say certainly for KCH, we've taken the time to really dial in a ton of our processes, automate what can be automated. So you're really looking at this next upcycle. A lot of these companies being, as ready for it as ever. So all that to say, it's different. It's a different market. It's a dynamic market. It always changes. A lot of things generally stay the same. So when you're looking at supply and demand and how they interact with price, that's something that you can really depend upon those dynamics playing out in a similar fashion they have in years past, but just how much of one or the other is, basically like how many trucks are on the road. There's still some not so good, ways to count that type of thing.
Right.
It's not a true known how many trucks are in a market at a given time. You have to use things like, tender volumes and load imbalances to try to understand how this markets will play out. And I'm not just saying that to make an excuse, but it's just to say, like, the uncertainty about what's happening in the second half from here going forward is only increased.
Yeah.
Even though, like, there's data points that are saying that make me feel more confident in certain things.
Sure.
I feel less confident in others, if that makes sense. Like the economy at large, not looking great.
Yeah.
Volumes in SoCal looking real bullish, right?
If anything,
That's one of those things.
I've become more confident in the uncertainty, if that makes any more sense. Is that I a few months ago or so, I would have been like, yeah, I got a pretty good idea, I think, listening to you and going through these other sources I've been looking at and being like, okay, you know what, I think I got a pretty good idea of what's coming in the second half. And I think all I've really learned is that, no, I don't.
Right.
I think, there are things that we generally were right about, or things that that anybody could have generally predicted about the freight market. But I mean, even at KCH, like you mentioned, things are changing so quickly. We're adopting new technologies so fast. We are making things more efficient and really just better for everybody involved. But it's changing so quickly that it's like, well, how can we predict the things that we used to be able to predict when it's quite literally changing every day?
Right. And that's, things like container freight futures. I mean, it's things that, it's the volatility. It's really, if you could 100% predict, prices, then you would make a ton of money.
Yeah, I was gonna say we would be rolling in money,
right?
If that were the case.
Well, we certainly would be making a lot more right bets than wrong bets.
Yeah,
and that's what you only have to be right. I forget who's been quoted, 50 some odd percent, right, and wrong 40 whatever percent, right?
Just right 51, wrong 49.
Well, as long as you're more right than wrong when you're making these bets and you're making them the right way, and you've got risk accounted for and all this. And this is what I've been telling our team. Let's understand a few things. The market sits here today. This is our strategy in terms of, because we have to basically, we're at rate agnostic in a sense. If rates go up or down, we're going to continue business regardless, right? It just affects, one side or the other, and gets either, more difficult or a little bit easier depending on the scenario. But I'm going to look a couple weeks out. I'm going to try to predict what's some risk, what's some volatility we could see based on current conditions. Then we're going to basically wait. Does it come true? Does it not? If it doesn't come true and those signals have stayed the same, then we may just push it back another week. If things have changed and it fails, then that's generally a bearish signal. So all that to say, when you're listening to these, it's not about who's right and who's wrong. I mean, I've been right a decent amount. I've been wrong. It's about letting the data for today help you understand what's to come, but then really making sure that those data points continue to support that trajectory. And then, machine learning is one of those things where it just kind of tracks those predictions and it tries to. So that's something that, when you're looking at price action that we're trying to do is really, predict where it's going to be. And then trying to let the machines do what they do best. And that's try to track, what's your margin of error, what were you saying here and it didn't play out quite like that, and try to account. So you're learning from it. You're constantly learning from your mistakes. But I digress. I think the rejection side of this is really important, obviously, because this is where my eyes are watching this like a hawk, because, you see in 2019, there was a small bump here in late September. There was some tariff things going on back then with Trump. It was his last year in office, but at the same time, it was really some really strong import volumes starting to come in as well during that time. So it's one of those things where we could very well see the market tighten up a decent amount. And if it tightens more than that spike, you're already going to be above 2022, 2023. So you're already looking at the tightest market for the drive-in segment in 2 years. So something to consider, right?
Yeah.
I mean, yes, seasonally speaking, if you look at the first half versus this half, but that's notable, right? That's notable. So when you talk about the truckload cycle being on its next, up cycle, this would be something that confirms that. So I don't think we've varied from where we've believed we are at in the truckload cycle either. It's just a rate of how fast will we get there.
Yeah.
And when you look at this chart, you tend to think that if Los Angeles and Ontario are already booming,
sooner rather than later.
These are for volumes that have just left. These volumes will not be here for another month to 2 months. It's just defying all expectations. There's a couple charts here that are pretty insane. This thing this high for this long is pretty nuts. Again, what did we say? We said it might, because we really don't know how long this will last. That's something that's a very big unknown. This is a typical peak season, but look at the past couple of years.
Right.
We are well above that. And who would have thought in this economy that imports would be booming like that?
So we would have assumed it to have been, winding down by now.
By now, absolutely. The last couple of days are worth noting. It shot back up after Labor Day.
Right.
It's coming back down. I mean, you're heading into Golden Week on the China side. That tends to Chinese New Year, Golden Week. This tend to, and you can see the dips here. The seasonality on those are very, very strong.
But it's still so much higher. I mean, it would have to
still
come
so much higher.
It would have to come way down to be where it has been traditionally over the last couple of years. That's insane.
So let's take into account that big spike right when that first spike happened, and let's relate it to this chart. That first spike happened. That freight's all got to get here. It's not all to Los Angeles, but we're all agreeing. The chances are it's a majority. Things are back to normal in Los Angeles, Long Beach. They can accommodate this volume. It's the fastest from China and East Asia. It's one of those things where it's a majority of U.S. imports. So if you look at the market share of all these things, pointing to SoCal, look at rail volumes coming out of Los Angeles. So this was the last time we talked, and it was at a high. Check out that spike. Look what it's being led by. International volumes, but even domestic volumes. But domestic volumes, okay, so let's see this red line. If you go back, it's just off its highs. International volumes are new highs, pushing total volumes to new highs. Again, I think the highest exposure to the spillover into the truckload market are these international volumes because of the delays they could potentially incur. That is not product that is sitting in a DC that can go intermodal or truck. That is volume that is coming in hot and literally, legitimately coming in urgent for peak holiday retail season at this point.
So basically what you're saying is because it's been this late of a peak season, you've got freight that's coming here later than it typically would. So it gets here in a month or two, we'll say a month and a half, whatever. We'll put it somewhere around there, a little over a month. All right, so that means it's getting here in October, middle October. You can't put that on a train at this point. It's too late. Like if you have to get it anywhere near the East Coast, it's absolutely too late for that. So could that be then the spike in the truckload market that you're looking for to say, all right, as soon as the rails can't handle this, here come the trucks?
Absolutely. And to think that even if these weren't a majority peak holiday retail season volumes, the ones that are on their way or have arrived are it's an insane amount of volume. Right. It's massively high. So even if some of that is hot and urgent, it's going to be icing on the cake in terms of it's really not a great, what do they call it?
Analogy?
Not an analogy. Is it an analogy or is it? But anyway.
Metaphor?
Regardless, it's
hyperbole, onomatopoeia.
Yeah. Idiom. Is it not an idiom?
Context. I don't know.
It's not an idiom.
I feel like an idiot.
Yeah.
Right now.
Well, I'm not an English major. That's for sure. But it's gonna add. Okay, here's a great one. It's gonna add fuel to the fire.
There we go.
So when you think about that, volumes that are already getting into the truckload market, they're already hot. Imagine the urgency behind those ones that are landing. 15, 30 days from now. I mean, you're going to be looking at a period where, truckload is going to be your only option, and then sucking in enough capacity where the rest of the market potentially gets hot. But I just wanted to so the spike's here.
Yeah.
Let's just keep watching this. So this is what we thought would happen. Spike on imports, spike in rail volumes, which we've had happen a couple times. So to me, this only goes higher.
Yeah.
Van outbound tender volumes in Ontario. This is the Inland Empire. This is the warehousing distribution market for Los Angeles, Long Beach. And Los Angeles has its own market. Ontario would be a lot of that volume that's come in, filled up the day. It really talks about the freight potential, this wait and see approach. If that were true, Ontario would be the one to blow up.
Okay.
The hot volume that's still hot as it's coming off the boat, more likely to be Los Angeles volume. Does that make sense?
Yeah.
Both comprise, at this current point, 7.6% of all outbound tender market share. huge numbers for both of these markets. That one part of the country, that much. If capacity flocks there, downwards pressure on rates. Rates still haven't adjusted. They haven't had time to catch up. That's why outbound tender rejections in those markets are so crucial at this point, because enough capacity thinking that the market's going to be, and the secret's out. We've been talking about this for 2-3 months.
Yeah.
I mean, the secret's out, record breaking, port volumes. If the last 5 years have taught anybody anything, it's like when that happens, go to the West Coast.
Yeah.
You know what I mean? Even though they may not have the data to be calling it that early, right?
Sure.
Secret's out, capacity's there, it's absorbing it. Rails are still taking on, in my mind, more volume than they can handle. So what is that really saying about what could happen to the rest of the country? It's basically saying that SoCal may get so hot. I mean, outbound tender market share for Ontario alone is over 4.5%. Just insane. So if you want
of the country
of the entire country.
Oh my God! I thought that was just the state.
No, it's the entire country.
My goodness.
And those two sit right beside each other. So again, 7.6% of the entire country's outbound tender volume. That's contracted volume being tendered to carriers on a daily basis, moving 7-day average. This is what it looks like. So spike in Ontario, California. Now, Los Angeles has also spiked, but it's kind of started to me, Los Angeles, if this is true and this volume's in Ontario, this may continue higher before we see Los Angeles kind of resurge and go even higher, because again, that timeline, the wait and see approach would enable that volume to get to Ontario before it's trucked. But since that timeline is decreasing, you're going to have a situation where it comes in, it's already hot, and maybe stays right there in Los Angeles and trucks out. Regardless, both markets are hot. How many trucks can continue to come into that market, take those long miles to the East Coast or east of the Mississippi without the rest of the truckload market now getting tighter? Because you're already seeing Atlanta, Harrisburg, you're seeing Elizabeth, New Jersey. When you look at the average length of haul, check this out, Ontario, average length of haul. Let's go all the way back to the peak of 2020, 2021. Yep. It has now been at its highest point in history, the average length of haul out of Ontario. How else could you explain that if it were not import related, and the fact that freight potential has been built up in Ontario and now they're taking long miles to the East Coast? So have we been right about that? I would say the data certainly supports it. Sure. And again, not about right or wrong. It's about trying to be as accurate as possible.
Still feels good to be right, though. I mean, come on.
Yeah. I mean, you definitely, being right or being mostly right would certainly help your morale and kind of continuing. To sometimes I feel like I should hang it up. This has been such a unpredictable market. But again, this has really been the thing to watch. And again, look at the whole landscape of the truckload market. This is the only thing, along with the port strikes, that is really going to drive any significant volatility in the second half. So it's the thing to pay attention to. If you're in pricing, if you're in brokerage, if you're a carrier, if you're a shipper, you want to know when the market, which is Southern California, Los Angeles, Ontario, when that market starts to show these signals, you want to pay super close attention, because what happens in that market, historically speaking, will drive the changes that we see in the rest of the market. And for exactly the dynamics that we said, you get these longer haul miles. Those are very, revenue per driver per week is the key metric every carrier should be paying attention to. Revenue per driver per week. Keep those truckers loaded for longer. Next thing you know, Los Angeles to Salt Lake, Los Angeles to Denver. This is what we saw before July 4th, and why it really looks like all the things were in line to be bullish is those rates were surging above contract. Those mid-haul, those more regional hauls, those shorter miles would be the first to see that upwards pressure. Right. And then eventually, those trucks that are now going long miles, they have to make it back. So now you've got this 7, 14-day, 21-day period before those trucks can make it back.
Right.
That volume continues to surge, and it kind of sucks capacity that way. Let's say if Ontario tender volume surged and it was city volumes, brokerages we are not out there helping shippers be more efficient at 50-mile runs.
Yeah, moving it across town.
Right. We're more efficient at helping you find capacity, source capacity when those miles are longer, specifically on 800-plus mile runs.
Yep.
So long-haul tender volumes, I didn't put it on here, that was the first to watch. And I've been posting about this because I think it's one of the most important things to watch. Even for the entire USA, it's already back to 2021 levels. And this was a couple days ago. But specifically, it's not just long-haul tender volumes. It certainly helps. It's kind of how that's playing out within a market. What you want to see is concentration of volume, market share. You want to see how that market share, reacts together to create a tight market. Because, and why we say SoCal drives historically the truckload market in some of these trends is that when it gets hot, it really heats up the rest of the country relatively quickly. And so we're talking about a 2 weeks, 3 weeks could look much different from now, depending on if these volumes stay elevated. Because if demand does not stay elevated, I won't feel this way come a week. But again, this is where we're at today. These are the warning signs to watch for. Where we're at next week, we can try and forecast, try and predict based on what we're currently seeing. I think most everyone would agree that this is something to watch. But that's what we're currently seeing.
Just to sort of leave our viewers, leave all the the shippers and even the carriers out there who may be watching. Just, was there anything else you kind of wanted to give them before we wrap this one up?
It's going to be a super strong peak season based on what we're currently seeing in the truckload sector from a demand perspective. It looks to be concentrated in SoCal. It also looks to be fairly robust in other parts of the country. So the truckload segment from the demand side is looking very strong coming out of Labor Day, where right before Labor Day, it had largely a failure to show any type of life. It seemed like it was going to be relatively flat.
Right.
We kept thinking the imports would drive this. I think, if anything, they only drive it higher from here. And the volumes that have stayed elevated for the last month to month and a half that are now arriving and will arrive for the next 15 to 30 days, those will be the volumes that really add fuel to the fire. So you really could see a much different environment in 2 to 3 weeks. Again, were we early? Did it not play out exactly like we thought? 100%.
Sure.
We're willing to admit that. But I think right now, the signals that we're seeing in the truckload market, not these other signals that would be related to the truckload market, we're seeing them in the truckload market. So the time has happened. The signals are occurring in the truckload sector specifically that if they remain elevated, it will happen quickly. So the warning signs are there. They've started to show up. Where they go in the next week, 2 weeks will be the main deciding factor for how we look for the rest of the second half, but certainly looking certainly more bullish than Labor Day.
Yeah.
But still a lot of unknowns out there.
Absolutely. Well, there always are unknowns with this market, as we've learned over the past few months or so. Obviously, guys, a lot to keep up with over the next month or so as we get closer to the holiday season. So it's more important than ever to stay informed. If you want to know what's going on with all the trucking market, or if you're a shipper out there and you're just like, man, I need some help because look at this is crazy. Well, that's what we're here. That's what we're here for. Check out our description. We got our website down there. You can get a quote. We got our other social media channels if you want to keep up with some of the other things that we're seeing. Henry on LinkedIn, he's got all sorts of graphs and he's got more daily updates basically. That a little bit more so than just what we're doing here. So if you want to really keep up with it, that's the guy. But in the meantime, guys, thank y'all for watching. Stay safe out there, and we'll see you next time. Bye.
See ya.